all sitting around staring at each other. Every one of us needs a little more coffee. Mike, you need better lighting. Let's try this again. Everyone, hands in, team on three. 1, 2, 3, team.
Yeah, that was a bad effort by all of us.
It was a terrible effort. People should have seen us on the green like, oh shit, yeah, we're gonna do a show. We're all tired. It's late in the day. No, we're not tired. That's what God created coffee for. Anyway, so this is our first Friday of every month. Technical trading show, not just for technical trading, it's for medium-term investing and even long-term investing. We break down some of these major assets in a big way, not just for hour to hour, day to day, but for what could be going on the next year. This is also a very special show because we are going to be launching something, a new project that we are incredibly excited about, and that's going to be the Finance Unfiltered newsletter. Bobby, if I say anything wrong, feel free to correct me. It's going to initially start out on what's that?
It's not Friday. You said it's Friday.
I said it's Friday?
Yeah, and we're live.
I just screwed up one thing. We're live today. It's Tuesday. Is it Tuesday?
Yeah, today is Tuesday and we're live. Normally to Jimmy, to back Jimmy a little bit, normally we record on Tuesday and it gets released somewhere between Friday and the following Tuesday. Today we are live.
So anyway, the Finance Unfiltered newsletter, which that's the way our Finance Unfiltered, FU, were we drawn to that acronym? I'm not sure, but it's Finance Unfiltered, which is FU. If you join through our promo code, you will get a 30% discount. We're releasing this on Slice. The reason we think it's interesting and is going to be of value, there are plenty of people out there with newsletters, and some of them are fabulous. This, with us, you get about 90 years of trading experience, but it's not just the trading experience. It's how varied that experience is. Bob and I are 30 to 40% fundamental traders, 60 to 70% technical. Mike Arnold is strictly technical, releases unbelievable videos of technical analysis. And the reason I think this is a value and why I'm excited about it is there's been a crap ton of times, and that's a technical term in finance, a crap ton of times where I will look at assets, break them down fundamentally, and Mike Arnold will step in and say, no, it's not time to buy it now. The momentum's not right. The pattern is not right. And then all of a sudden we'll wait and he will get it right. And when we go over a certain spot, then it is the place to buy it. So this collaboration has worked out very well so far, and we want to share it. Is there going to be a fee? Of course there's going to be a fee. We are capitalists. We want to make a buck too. Producers need money. A lot of people need money. So we have done a lot of free things on Twitter, and we'll continue to do a lot of free things on Twitter. This is going to be a step up, and I think it's going to be of real interesting value. Bob, what do you got to add to that?
So this newsletter is, first of all, it's going to be weekly, which is going to be a decent amount of work, but you're going to get, as Jim mentioned, all three of us on this particular newsletter. You're going to get Jim's takes on things, which are usually hot takes. He's usually ahead of the curve. Even if he's wrong, he's usually ahead, and he's the first one to say he was wrong. You're going to get all of Mike's levels for all the major markets. I'm talking about Dow, S&P, NASDAQ, Russell, crude, gold, the dollar. And then you're going to get stock. We'll call them trade examples, but they're stock picks since I don't have a licensing issue like you do. Where you're going to get stock picks from me filtered through Mike. And then you might, on occasion, get options trades in the futures realm from Jimmy, things that he's using as examples of how you might want to express an opinion. So there's going to be real data in this. There's going to be actionable information on in this particular newsletter. The thing I like about it, I sent it to a friend of mine in the industry recently, and he goes, is this thing really 13 pages? And I go through it. It's got big words and a lot of pictures, so like a Gerald's book. And he went through it. And he goes, yeah, I got through this pretty quick. I actually like X, Y, and Z. These were trades that he was actually going to do. So what Jimmy said, there is going to be a cost. But when you see the cost, number one, you should be able to make it back in any of the ideas we give you. That's number one. There's going to be some losses on there as well. But more importantly than that, 13 to 19 pages every week. Again, you don't have to read every single section of it. It's all going to be in digestible information and charts. So everything you'll be able to see on here. This is the kind of work that three of us have done independently and together for what amounts to a combined 90 plus years. So I think this is going to be very valuable. I think a lot of people will get a lot of information out of it that they can actually use after the first time they read it. You guys will be the telltale sign of that. Now, there is going to be a discount code for a while. Finance 30 will be that code. So when you go to the app to sign up. Again, it's going to be on the Slice app. You can either go straight to their page and create an account and then just search for us, which is slice-app.io, or there's going to be a link that goes directly to us in the description of this video once we're done with this live stream. So, and Jim and I, and probably Mike, will also put the link into our X or Twitter, whatever you call it, profiles as well. So there's gonna be a lot of ways to find us. And again, value is what we're trying to get out of this, what we're trying to do. And I want to say good morning to everyone who's watching us live, by the way. I should say good afternoon. Sterling, Patrick, David, Harold all said good afternoon already. So I'm excited about this, man. I'm really, really excited about it.
Me too. And I don't want people to think that it's just for like hour-to-hour day traders, not just for day traders. My trade where I make the most money is using put flies and call flies, sometimes making them a little bit unbalanced. And I'll explain this in extreme detail in the newsletter to take advantage of 2 and 3 week moves. The latest one 2 weeks ago, I told Bob about the call fly I was putting on in silver. The beginning of last week, I told Bobby about the put fly I was putting on in stocks, which, by the way, if you've been watching our show for the last year to 2 years, you know that one of the themes over the last 6 months for Bobby and I both, and Mike Arnold, was that we didn't love stocks, but we did love gold. And I mean, again, I'm not trying to give us an attaboy. I'm just trying to say we're not gurus, but every once in a while we hit one solidly off the good part of the bat, and not those new torpedo bats that the Yankees are using.
Yeah. So again, I'm excited about this. Mike doesn't have any comments, but he is going to be a major part of the newsletter. So we asked him before we started, Mike, you want to say anything about the newsletter? He's like, I just want to talk about markets. So, okay.
I do want to say something.
Typical Mike.
Mike's our quant. You see our quant?
What? You just said you did want to say something?
Yeah.
That's a shocker to me.
You know what? I thought of a great benefit, though. Because I'm on this once a month. In patterns, we can make the calls. And a lot of them, there's going to be a potential double bottom in the S&P we'll look at today. But things evolve over a 3-week process that you don't necessarily get updates on. And if you get the newsletter, you'll be getting the constant updates, and patterns can change and evolve, become invalidated. And especially when you're learning stuff, you might follow along and then say, oh, now I realize why that became invalidated, or why that triggered, or why now the thought process has changed and the technical setup has changed. So that's something, since we don't do this every week live, we do it once a month live. You're sort of getting the behind the scenes every week.
And there's one last thing I'd like to add too. We had Tim Melvin, who is really an excellent value trader, on the show about a month or so ago. And we're talking to him, and I know he makes money. I know I've seen some of his picks he has. So I said, why do you put out a service? Why do you engage other people? And he goes, well, basically because trading has evolved into something that's kind of mind numbing and lonely. You sit at a computer and watch it all day. Being part of a community not only helps the members of the community, it helps the individual mentor, let's call it, because it helps us sharpen our views, and talking to people brings us kind of back to life. Bobby, you'd agree with that, right?
I would. And, again, Jim and I know each other from the trading floor. Mike and I have been business partners for, God, I don't even know how long it's been, Mike, now. What's it been, 20 years?
It's been a long time.
15 years, something like that. And I know Jimmy longer than I know Mike, and I have them to bounce things off of. But this is going to become slowly but surely a community. Slice is our first launch in terms of where the newsletter is going to be. And that 30% discount, while it's only going to last for 15 days, it will last for the entirety of the package you choose. So if you sign up month to month, we're happy to have you. Sign up for 6 months, you'll get 30% off for 6 months. You sign up for a year, you'll get 30% off for a year. So I think there's just going to be a ton of value in this. And I think the thing that Mike said is very key. We have Mike on here once a month, and we always are reminding people on our shows to go back and check what Mike did last month. And you can see it every week. Jim and I are constantly saying things like, I remember in 2 shows ago, I said to buy this. Well, now it's going to be in the newsletter, right? There's going to be actionable advice. I don't even know if I want to call it advice, but there's going to be transparent portfolio suggestions. Okay. Buy it here, stop yourself out here, targets here, and we'll update those as they go, and we'll put new ones in every newsletter. And if there's no trades, we'll put that in the newsletter.
Right.
But you'll still be able to see all the levels in case the way we trade is not necessarily the way you trade. I know that, Jim mentioned these options positions. My average hold times are on 22, 23 days. So it's certainly not day trading. So this is possible investment advice as well. There's going to be a lot in this newsletter.
But remember, there was one thing, everybody who launches this shit talks about how they're gurus and trade masters and how they did this. We're just regular guys who've accumulated a little bit of knowledge over the last 30 years and want to discuss it with people who are smart and share what we know. We're not gurus. We're not going to make you $1 million tomorrow, but we can put you on a path to being able to control your finances a little bit better.
Yeah. So let's end the commercial by me saying hi to Ha. There's somebody in our chat who used the name HA, Ha, and said hi. So I just said hi, Ha.
Hi, Ha.
Yeah, that's what makes sense to me. Anyway,
let's roll. Let's talk about, because like I said before, we talk about different time frames, traders, intermediate term, and investors. Okay, we're all investors in the stock market. I mean, we're silly if we're not. Let's look at S&P 500, which I had when it broke through. I believe it was 5,700. That's the weekly chart. So if we had the daily chart up, I had my sell signal. That the red bar, when it about like 3 bars ago, that's where I put on my trade. No, when it broke the pennant, the upward movement. So yeah, right in there. That's as soon as it broke that's where I put on that put fly that targets 5,600. I actually thought the newsletter was live at the time, and I put out that put fly that I bought for 3.7. Now it's trading at about 4.5, but I want to get out of it. Tomorrow for 7, but if it goes beyond that, I'll need more to get out of it. But anyway, Michael, what do you see on this?
All right, so big macro picture. We've made a potential, I'll stress potential, double bottom pattern at the second target of the double top. So we've again bounced off that key area a couple times. Now, I really like this setup. Not that it changes probabilities, because I like it. Because if we did, who knows? We got the tariff announcement tomorrow. Then we're going to get reciprocal tariff announcements and everything else. But after the dust settles, and if this pattern's still valid, if we do close back above on a weekly basis, the high of 58.37.25 technically, then we'd be triggering this double bottom pattern. We'd be out of the way of the weekly rotation zone again. And we could then, probability-wise, return to the all-time high area. Now, that does not mean we just run out and buy this tomorrow, because this may never trigger. But that's the nice, clean, bullish potential setup we have. Keep in mind, though, on any rally, even up to, we have a cluster area of about 57.55 to 57.75. We run smack dab into the declining rotation zone. So we might never trigger this bottoming pattern. We could still rally in the short term. We have weekly cycles headed up, like in stuff like the NASDAQ. We spiked lower this week, and then we making some divergences. We'll look at that when we get to the NASDAQ. But we could then roll over without ever triggering this pattern, because we still have more potential downside ahead. So I'm still watching for rollover plays, unless this double bottom were to trigger. If this double bottom were to trigger, that puts me back in bullish mode on at least a weekly basis. Until that triggers, I'm going to be varying degrees of neutral to bearish still on a weekly basis, and on a daily. And this could be front run on a daily close above that key level of 58.37. But then if it does not follow through on a weekly basis close, I would not be holding it. So that's key to the upside. Now we have the tariff announcements. Who knows what's going to happen? Who knows if the markets is now going to be, we know it's coming. We'll rally. But if we don't rally and we take out last week's lows from the 13th of March, the next minor target from the double top is still 54.65. Then the major area on a really big breakdown is this 53.30 to 53.50 area. That is key. The other thing I'm watching, if we do roll over again, is at this about 55. Let me give you the exact number in here. 55.12, 55. Just remember 55.10 is close enough. If we close below that on a daily basis, we've then triggered the probability shift where it will be lower prices, and the magnet price based off the probabilities would be about 52.50 over the next few weeks to months. That does not happen right away. I'm not saying it's going to fall and crash down, but that's why I'm going to be watching that 55.10 level on a closing basis if we do roll over.
So that I like, because again, that links up with what I thought too. I had 5,400 as the downside. Your target is better, but I do think so. Right now, if I had to put a finer point on what you said, and by the way, for those of you who are new to watching us, I always kind of press Mike on the -3 to +3, bearish to bullish at this moment. So right now, I think what I'm hearing is you're a -1, a close below 55.12 makes you a -2.5, and a close above, you said 58.40, 58.36, right? Well, 58.40,
58.37.
58.37. That's a close above there. See, one of the things we differ on, Mike likes to close up there. I like a close up there, and then any sort of strength, the next bar after that. That's what I've had good luck with. Bobby, what are your thoughts?
So I actually want to ask a question here. So we've got the double. First of all, you talk about it being a weekly double, and then you could theoretically front run it with a daily close, but if it doesn't close on the weekly, what stops this from being a daily double? Potential daily double.
Because we're against, you could still trade as a daily double, but since we're against a weekly rotation zone.
Okay, so the weekly takes precedence.
You need the weekly rotation zone. If that was well out of the way, I'd say just go ahead and trade it on a daily. That's why I say you can front run it, but again, there might be some upside. But we've seen so many reversals, and there's so many things. We're in a very volatile market. So let's say it were to close on a Monday above that level, but who knows what's going to happen by Friday? And if it doesn't trigger, if it doesn't follow through with the trigger on Friday, I wouldn't want to be. The probabilities wouldn't be there.
So I'd just like to point out when people have made comments. So Ha said his name is Harry, but it got shortened by Google, and he's a longtime fan of us. So Ha is not Ha, it's Harry. And then Brian says,
I kind of wanted your name to be Ha, Harry.
And then Brian says 52.50, the market will finally be fairly priced again if we get to 52.50, which I get what he's saying. So Mike, here's my other question on a daily. Okay. I've heard people start talking about death crosses. Now, before I ask you a question here, right? The research I did on death crosses is they're kind of crap. In other words, excuse me, when a death cross happens, the market generally rallies up to the intersection point before it actually comes down. And then oftentimes there's a news event that makes it break through there anyway. So I wouldn't even look at a death cross as being a thing unless it crossed and then got tested and then failed from there. What has to happen for that? I mean, these are longer term moving averages, so they're going to continue to move in those same directions, are they not?
Yeah, I mean, like the 200 is going to take a while for it to roll over, and death crosses are not a reliable pattern. What's funny is once you see people say, "Oh, you just triggered a death cross," you generally get the rally.
You get a big rally,
and then you can get the rollover play. It's sort of a contradictory short-term indicator. I'm not saying it's not something for the longer term, but it's generally not something you just want to say, "Oh boy, death cross happened on Monday. I'm shorting the crap out of this market." No, and the 200, since there's a lot of data points, and we're still just hovering right below it, it's like a freight liner turning. It's not, it's not a speedboat. Okay. Yeah. Your 8 EMAs like the speedboat, your 200s like the huge cruise ship or the freight liner. So these things will continue heading. Now the 50-day, when we use the exponential for the 50 also, the only one we use for the simple is the 200. The 50-day will be quicker to react than the 200, but again, it's going to take a lot of price action. It would take some major price action to the upside to prevent a death cross at this point.
Bobby, I have a quick question for you.
Go ahead.
So tomorrow's, what are we calling it? Liberation Day?
This is where I was going. Go ahead.
So when Trump pumps things up like this, Your expectation is for him to give some good news. He's not going to pummel the markets after he's drawn every bit of attention to it, is he?
No, I don't think so. And he said something I think was telling in one of his shortened press conferences. I think it was yesterday. He said reciprocal tariffs. That basically means that if they have a tariff on us, we're going to put one on them. He goes, but we're going to be a lot nicer to them than they are to us. Believe me. Trust me. I know what I'm saying. A lot nicer. It's going to be big, but it's going to be small. It's going to be the best you ever saw. Nobody ever saw tariffs like this, but we're going to be nicer to them than they are to us. So the assumption, I think, and part of the reason I believe, just from a fundamental side, I'm guessing on this, that we've gotten a 2-day rally is because he said that yesterday. So that started the rally yesterday with that long wick. You can see on this chart. It's even more evident on the NASDAQ. But he's basically saying we're going to put reciprocal tariffs, but not matching tariffs. So in other words, we're not going to get 200% on Indian automobiles like they have on US automobiles. We're not going to get 100% on European dairy like they have on US dairy. There's a lot of tariffs out there people don't know that they have in place and have had in place, some since World War II.
Yeah.
And
people acting like tariffs are the craziest economic policy in the world have zero understanding of economic history.
I have another thesis before we get to the NASDAQ.
Sure.
For everybody who's saying that tariffs are guaranteed to cause inflation, or the studies all show they cause inflation, have tariffs on American goods caused broader inflation in these countries that have held those tariffs?
No.
I haven't seen it.
No.
I mean, I haven't seen it. Europe doesn't have tariffs, a broad-based level of inflation on the U.S., on the tariffs they have on the U.S. Canada does not have broad-based inflation because they tariff U.S. dairy and U.S. lumber. So I don't know why they need, I mean, I get things are different. We have a much bigger economy. We buy much more from them than they buy from us. But I think that's what we're trying to change. Anyway.
Got it. What else you want to what you guys want to look at?
NASDAQ, please.
Damn straight.
Yeah, there's that long wick I was talking about.
Oh, and the long wick there was below that low. It's interesting because I haven't looked at this as closely as I have the S&P. So let's take a look.
Yeah, this is NASDAQ. Also, we have a bullish RSI divergence. So we still have a potential double bottom, even with this lower low. The only thing that would invalidate the potential double bottom in the NASDAQ if we trade it below 18,790 invalidates the pattern. Today, we're triggering a %B buy bounce pattern in this with the target somewhere in the region of the daily rotation zone. But if it continues to rally with a close, again, could be on a daily, preferred a weekly, above 20,537. And that would take it, if we look back at the weekly, also, because this will continue down the top of the rotation zone, that would take it out of the way of the weekly rotation zone. And on the daily, that would regain the area of the flattening out 200. It would also regain the declining 50 EMA. So a lot of technical roadblocks would be out of the way if that were to trigger, and could take us back to that 87F harmonic area where the final target would be for the double. So that's another thing I'll be watching. Now,
can you give me that level one more time before you move on?
Sure. 20,537. Just look at the newsletter, Jimmy.
Okay. How do I access it? I'm still me. I don't know how to get on it. I send things to Bobby and he puts them in the newsletter.
20,537.
Got it. Moving right along.
To the downside, because remember, the trend is still technically down. We could see bounce plays. We could see bounce plays into the weekly rotation zone. Even a key level is 20,230 on a, let's say we have a multi-day rally. We hit up there. It's still potentially looking for rollover plays. And to the downside, if we did break, yesterday put in a new low first last week, but we do have divergences, which means we made a lower low in price action, a higher low in the RSI overall on the weekly basis. But if we take out Monday's lows at 18,976, we have a very strong cluster right around that 18,750 area. And then the very key level on a further breakdown is about 18,350, where we have a harmonic and technical support pattern.
So here's another quick question, and then Bobby, let you in. And this, I guess it's for both you guys. We haven't made any headway since December. This has been, it's a long sideways pattern, then a break. So when you're looking at like, is it an acceptable correction to build a base at some point in time? Do you take into effect that we traded sideways for a couple months before we fell off? What do you guys like your gut? And this is, opposed to technical analysis, but does your gut tell you that the correction is getting long in the tooth or no? Mike first.
I don't think the correction is getting long in the tooth just yet. I mean,
I actually don't either. Yeah.
We actually made some, I do some stuff with DeMark setups too. I don't talk about all the time. We made some major topping patterns with DeMark. We made some Elliott wave stuff I don't talk about all the time on this channel. But we made some very key massive weekly topping patterns. Does not mean we can't rally back more than people think. But then I'm still going to be watching longer term for the next rollover. From a gut feeling, yeah, people were somewhat, the Twitter panic on this drop, but everybody's still like, oh, buy the dip. I want to hear, when we get a correction where people are saying, I think I'm going to hold off buying this dip for a while. Then
buy the dip.
I'll start watching more aggressively. That's from a psychological pattern, So technicals are one thing. Again, I can't get overly bullish until we trigger some key bottoming patterns, and those could be just for a few week run before the next rollover play. But this is the sentiment that is not there. There was no real panic in the street. There was no, oh, I'm going to throw in the towel. Oh, I don't want to just rush in and buy the dips on some of these other stocks. I look at what happened with Newsmax over the last couple of days.
Jesus.
I mean, geez, the company does not make money.
Yeah.
Okay. It's fine. It IPO'd. A lot of IPOs are companies that don't make money, but it's bid up. It was at one time it was trading 100 times price to revenue. Jesus. Price to revenue.
Yeah.
Wow. I'm sorry that we do not have major bearish sentiment if an IPO all of a sudden is trading within 2 days 100 times price to revenue.
Yeah. So, a couple of things. Number one, I don't think the correction is long in the tooth at all. I think when I'm sort of old school in this, when I look at the steepness and the length of recent rallies, right? The sharp drops being, 15, 18%, they don't bother me. I tweeted the other day, it cracks me up to watch everybody panic as if they've never seen a recovery. And my point in saying that was, we will recover from this decline as well, right? So from that perspective, I don't think this is a long decline at all. Mike just put up a monthly, which I think shows a lot. I wasn't going to ask him to do that, but I think he knows where my brain is going with this. Look how brief that is. Like, it's nothing. Yeah. It's 2 months of moves after, I don't know, what is that? 2 years of basically a rally. We had 3 months of moves in there. That is a massive, massive rally. And we've dropped for 2 months. We haven't even dropped 15%.
Yep.
So actually, the new low might have been just really close to 15%. I'll measure that out in a second. So I don't think it's long in the tooth at all. I think we might bounce from here, but I still think that there's one more downdraft coming because I don't think the markets have yet sorted out some of the things Mike just talked about. In the newsletter, for example, yeah, look at that, Jimmy. The drop this is the S&P futures from the all-time high. I'm not showing it to you, by the way. Yeah. From the all-time high on December 17th to the low 15.38%. So I am now vindicated as correct.
Well, not only correct in the S&P, that Russell was down 19%. The NASDAQ was down like 17.5% at the low. So in my mind, you're right. And for you guys who don't know what we're talking about, Bobby for the last 3-4 months said he believed there was going to be a 15 to 30% correction, and then it becomes a generational buy. Now we've had the over 15% correction in all three of the indexes. He's not saying it's generational buy yet. No. Now you got to see the bottoming pattern and start to
we got to see the bottoming pattern. And I mean, I'll switch over to Mike, and then I want to go to some of the live stream chat, but I'll switch over to Mike. What would you see as a bottoming pattern? Like, this chart certainly doesn't look like one to me.
No, we don't have any long-term bottoming patterns yet. We just have short-term bottoming patterns. And again, this is now that I switched back to the S&P. Does this look like a major correction just yet based off this chart? I mean, the last substantial correction was 22, you know, where from December 21 really to November 22. And then we've been on a major tear with a brief little 3-month pullback in there. This, people have very short memories. Now, we are within the monthly rotation zone. We have not closed below it yet. So would not be surprised to again see bounce patterns. But then unless we those would be bounce patterns only. Even what I pointed out with the day, even if we triggered this, that could take us back to potentially the high area, but not make new highs before another rollover. So that is it a tradable bounce? Yes, but is it something I back up the truck and make an investment that I'm going to hold potentially the next 3-4 years? No, it's not. Again, I will look at fundamentals where you said I'm 100% technical based, yes, for trading patterns, but I will look at fundamentals for long-term valuation of stuff, especially if it's something that's going to go in my portfolio as a long-term hold that I'm not going to touch for years. And the market from a valuation perspective is nowhere near cheap at all. So we got to take that into account. There's tradable bounces and then there's long-term investments. We don't have, if this thing were to continue lower, we still don't have a potential major bottoming pattern yet.
Okay, cool.
So I want to go to the chat if I could real quick.
Sure,
as Mike's switching this to the Russell. First of all, Remo, it's stock charts. If you guys don't follow Remo on X, you should. He's a great follow. He says, isn't inflation monetary supply or money supply, I should say? Now, that's actually a really excellent question because we've been talking about the Milton Friedman quote that inflation is always and everywhere a monetary phenomenon. And now there's talk of tariffs causing inflation. And I'm struggling to think of a way that that's a monetary phenomenon. But I will say this, there hasn't been inflation with tariffs so far.
And Bobby, if they did, it's got to be a one-off in the inflation. And unless some inflation expectations change dramatically, which would mean the market is stupid, then it is just the 10%, with the maximum it would be, because we're not restricting supply. And as a matter of fact, the inflation part of it is absolutely absurd too, that everyone's like, well, if he increases it 20%, that's a tax on the consumer. Yes, it might be. Also, there's the possibility that the exporting nation subsidizes, which, by the way, happens a ton of times in the past. The exporting company may shoulder some of it and rely on less margins. The importer who imports materials and then gets out finished goods may suck up some of the losses as well. This is split between 4 things, including the consumer. I'm sorry, I'll stop ranting.
No, it's okay. One of the left-wing AIs, I asked the question of why there wasn't broad-based inflation in India based on the U.S. Autos being tariffed at 100%. And the answer was, well, that's because the Indian populace buys a lot more Indian cars. No shit.
That's the point of it.
Tariffs on U.S. cars. Why would they buy?
Point of it.
That's the replacement theory of inflation, where people will buy something cheaper when something else's price go up. And that's why in the last batch of tariffs, a lot of the producers and a lot of the countries absorbed the tariffs. And then Sterling comes in and says government printing money and indiscriminately dumping it into the economy causes inflation. And then he said Newsmax got bigger than Fox Corp today, which I think is what Mike's saying is ridiculous. All right, Mikey.
I mean, again, you don't see that kind of behavior at market bottoms. Okay, that's all I'm saying. So, Russell, real quick, we do have another potential double bottom. Would need a close above 21.26. That's the. Let me get back to the weekly. That's the key area on the Russell right there. I don't know why that's not showing up on the weekly. Let me just fix that. There we go. There we go. So that one's not out of the way of the rotation zone. So the probabilities are lower on the Russell one. If I was going to, you're going to have to pick and choose unless you have an empty portfolio. I mean, some days I see especially with bottoming patterns, if you're taking the stocks, I might get 10 or 12 trigger on one day. So it's not like I could take every trade at size. But if I was looking to take 1 or 2 of them, I'd be looking at the S&P and NASDAQ. They'd be the higher probability versus the Russell. Now, if the Russell rolls over and trades back below 1950, the doubles off the table. If it closes, the key level on a close for the Russell is 1953. We close below there. If we roll over and close below there before triggering this double, then we actually have the next key major magnet harmonic between probability wise and reverse harmonics. We're looking at about 1848 to 1862 is the major key level to look for next.
Love it.
Sterling added here, I will say the auto manufacturers will eat most, if not all, of the tariff charges. Sterling works in the auto industry too, so that's coming
and
from
he's not a dumb guy by any
Yeah,
stretch. Thank you,
not a
Sterling.
dumb guy. Can we look at gold, because I have a specific question here?
By the way, you guys know that I put on some pretty major hedges today toward the top, right? I told you that, guys, on Twitter, and I bought put trees where I would buy it again at 2,500 by June. So I bought a put spread and then sold an extra put where I want more gold. So just apropos and nothing. To me, it just looked a bit stretched. But anyway.
Well, so here's something that I think is a big deal about going to the Slice app, which it's now in my bio on X. If you guys are watching on X, go to the Slice app and sign up for our newsletter. Because if you want to differentiate between mine and Jim's and even Mike's market-based comments from our other bullshit that we put on Twitter all the time, Slice is going to be only market-based comments. So those particular
Wait, I can't piss anybody off on Slice?
Well, I guess you can. You can be right. They don't subscribe. So the thing about Slice is, so for every 5 posts, one of them is free, and the other 4, in order to see them, you have to subscribe to our newsletter. So the more we post on there, the more you guys will get little free samples, but then you won't get the newsletter itself. Or, for example, Mike's been posting over the weekend about some of the very same stuff he's talking about here. And the good thing about doing it on Slice is you'll be able to see our posts, and then you'll be able to see Mike and me and Jim talking about the stuff on our podcast. So that's something else interesting. But what I wanted to ask about gold here. So today was the first day since the gold long conversation that was in November of 2022, where I've said, well, that's not true. I sold one gold coin in 2023, where I said to myself, I might need to sell some physical right now. And just looking at it, how these 4 sessions are parabolic in a way that I don't see anywhere else on the chart. So Mike, what is your thoughts on here? We obviously have hit, well, have we hit any key targets?
We hit a key target cluster. We're holding just above it right now, and that's this 3142 was a pretty significant cluster area where we're just basing above it. But this is now overextended. We're at cycle tops on a daily basis. It's very overextended on the daily from the rotation zone. The weekly, again, remember last run up we had 1, 2, 3, 4, 5, 6, 7, 8. Then we had the big correction back to the weekly rotation zone. Now we're at what, 5 weeks higher, getting very overextended again. We're even more overextended than the last run up before the correction. And we have a major technical divergence up here. We're getting the weekly cycle tops. So does this mean sell all your gold and walk away? No, but I was on the last week, I think, or the last couple of weeks, I've been on a 3-3 bullish daily, bullish weekly. Now I'm dialing that way back. I'm hitting neutral mode on the daily because we don't have a major shorting pattern yet, nor would I short this. I'd use those levels to look for key pullbacks. And on the weekly, I'm dialing that down because we're just too overextended. Doesn't mean we can't keep going, but I know depending on your time frame where, like for short-term trades, like let's say you bought the last rotation zone up. On short-term trades, I'd be pretty much trailing below today's low. On long-term trades, like you bought last December or even before that, you bought, the last major correction in November of 24, we're nowhere near. I mean, unless we were to break back down below roughly about 29.75, it wouldn't even start doing technical damage from a weekly perspective. So you need to know based off the duration of your trade, where your stops are, because I definitely for short-term trades be raising them and not chasing the market higher at this point. This is not where you want to be dumping in more money when we're getting this kind of overextension.
Yeah, and you guys know, Bobby and I have been being accused of being gold bugs, whatever the hell that means, for 3 years. I'm up to my eyeballs in gold. It has been my biggest single position. I think it's my biggest single position, but
it is now.
Yeah, it is now, right? So to me, my putting on hedges today is, in a lot of ways specific to my being up to my eyeballs in gold, which I am happy as hell to have that position on, although it's kind of scary to me that gold is flying the way it is.
So I want to jump to the chat again, if I could, unless you guys have anything more to say about gold, because Widge, who's one of our favorites, requested a 10-year chart. Now, I don't know if Widge wants the yield or the price. Doesn't
I
really
like to
matter.
look at yield and futures. I think people like that more.
I do.
Is that okay?
Yeah.
Because I've been looking this. I have this up at my desk all day long, and Widge, I see what you're seeing too. Breaking below that level seems significant to me, and I'd like to hear what Mike's got to say.
Well, this would be a major head and shoulder. It's not a symmetrical head and shoulder top, but it is close enough that we could trade this as a horizontal neckline. I'm watching on a closing basis, especially. This is one I also want to see on the weekly closing basis. Close below this 4.15 basis on the micro yield chart. And then the key targets for me are about 3.83, 3.66. So we could easily get back to the low yields from September of 24 should this pattern unfold. We're also getting the first cross of the weekly rotation zone, which happened a couple weeks ago. So that is that we don't trade crosses, but it helps keep me on the right side. So unless we start getting a substantial rally in the yields, I'm going to be watching this pattern to potentially unfold and watching for the pull back to near those. If it plays out with the first and second targets, the third target, the rule for this is the first and second targets have to be within the candle bodies that started the move. And they are, so those will be the first two targets I'm utilizing for that pattern should it trigger.
And when that pattern triggers, and this, depending on when it does, the newsletter will come out Friday, right, Bobby? Because I will have some put flies that I will probably have on by then that I think will be interesting. I might have like a strip of put flies on that have the middles of the targets we just said, duration wise too. I mean, I know I'm not explaining it very well now, but subscribe to the newsletter and I'll explain it very well because I have a trade for this if it triggers.
Well, actually, I want to be clear. The Finance Unfiltered handle is live, I think, on Thursday on Slice. The newsletter is going to be released Saturday or Sunday.
And I can on Thursday, then if I have a trade, I can put in and explain the trade on Slice, correct?
You can put it on Slice.
By the way, if it surprises any one of you that I don't, who's watching, that I don't know exactly the technical aspects of it, you haven't been paying attention very long.
Tim over here, Tim, of course, neighbor of mine, friend of yours too, Jimmy. Navarro, that's of course Peter Navarro, who is the senior counselor for trade and manufacturing in this administration. Navarro predicted 700 billion of annual tariffs under Trump 1. Tariffs increase by 35 billion. So if you raise tariffs revenues by 665 billion a year, won't the U.S. economy have issues? So I want to say something real quick here. It's not going to have issues if we raise tariff revenues by 665 billion a year. Okay, that'll cause no issues.
That'd be great.
All that. So I think what he's trying to say is if we're beating up the rest of the world for another 665 billions, won't that cause problems? I think it's more likely to be seen in stocks than in a general economy. You guys can disagree with me if you want. So for example, using what Sterling said, I think the auto manufacturers will eat most, if not all, of the tariff charges. Okay. That's margin compression, right? So that will hit the stocks and that will hit stock across the board. But I think if you have to think 2 and 3 steps from now, if they actually get to 700 billion in annual tariffs, that will theoretically trigger the next phase of what this administration is trying to do. And the other day I put an explanation about this on Twitter. And then certainly somebody said, Bob Ichino's now MAGA. I'm not MAGA. I mean, I would like America to be greater than it is, but this is not why I'm saying this. The second stage of that is massive tax cuts, massive cuts in regulation. And according to Lutnick, the Commerce Secretary, Howard Lutnick, he said Trump wants to eliminate income taxes for people making less than $100,000. Now, that is the long shot of long shots, right? But if actually these things happen, you can't think of it, in my opinion, in a vacuum. What do you guys think?
No, I agree completely. I think that the American economy is unbelievable resilient, and what it does, believably resilient, and what it does best is adapt. Am I scared right now that the growing pains might be difficult? Of course I am. Do I think it will adapt? Of course I do. And our economic juggernaut status gives us unique leverage. Now, our trading partners can be rightly pissed at us, and they will be rightly pissed at us, but I don't think there's anything we can do. I'm not saying I agree with us strong-arming everybody, but I'm saying we are strong enough to do that. And I do think this could be an interesting pivot. And if we don't piss off people too much and they are not going to cut off their nose to spite their own face, which, by the way, is not above the scope of possibilities, I think we're going to be fine. I'd like to get to Tim's question about 3.6 high yield. I mean, 3.6 in the 10-year and high yield.
All right. So that question is, if we get back to a 10-year of 3.6%, is that good or bad thing for the U.S. economy? Also, any comments on high yield spreads widening?
By the way, the high yield spreads, that's one of my other things too. I always keep a chart up of M2, but the high yields are one of the reasons I'm bearish as well. So there's
the high yield spread chart.
Yeah, that to me is a big deal. And that's one of the reasons I've taken off some small amounts of the put spreads I put on in the S&P, but I am still relatively short the market, meaning I'm not exactly short the market. I've just pretty much hedged all my longs is what I mean.
Credit spreads, just real quick, credit spreads are now above their 200-day moving average. And according to Mike Singleton from Invictus, returns for the S&P 500 when credit spreads remain above their 200 are dismal compared to when it's below. Still slightly positive overall, but the win rate goes way down. The data just gets really poor. Go ahead.
And by the way, and this is going to be a surprise to Bobby too. If you're one of our first 20 subscribers too, if you ever want to have a Zoom call with me, and I'll try to suck Bobby into it too, we will go into in depth about why the credit spreads, when they're tight, could be an example of excess liquidity in the system. When they're loose, when they're tight, and when they start to broaden out like this, what implications that could have. Because I think this is a major theme. We just don't have enough time to go into it, so deeply. But the 3.6% on the 10-year, one, it will indicate that stocks continue lower because they'll be pushing money into treasuries. It'll maybe indicate that there's less supply. We've cut defense spending, but we'll be able to refinance $9 trillion of debt in 2025 at 3.6 instead of 5.0. So eventually that'll be a very good thing if we're smart enough to term out our debt.
Mikey, anything?
Yeah, just in the short term, if we do trigger this pattern in the short term, pay attention on a closing basis, a daily closing basis, to make sure we follow through below 4.05 on a yield basis. That's going to be the major tipping point from a probability perspective.
Love it.
So yeah, even though the technical pattern, it will trigger on a flat neckline about 4.15, the key level I'm watching for short-term follow through is if we can get below that 4.05 on a yield basis.
Sterling, I'm giving you an absolute thumbs up. Yeah.
Just real quick, something I had not seen. Says last updated an hour ago on this news story. Israel has announced the removal of all tariffs on imports of American goods. A decision made by the Israeli finance minister. I'm not saying that. This move is aimed at strengthening economic ties between Israel and the United States. The decision comes in anticipation of potential U.S. policy changes regarding tariffs.
Well, so maybe Trump's not an idiot. Okay.
Yeah. So another one by Sterling here. If you understand the history of how we got these huge disparities in tariffs between the U.S. and other countries, you would understand what Trump is trying to do. Fair enough. That's a very fair comment. I would like to put up Tesla, Mike, if we could, for one reason and one reason only. Okay. And you may be able to guess this reasoning if you know my political leanings for this particular cycle.
Which is no political leanings, which is policy leanings. I know Bobby too well. Sometimes we say it wrong. We have no interest in politicians. Yeah, go on.
On March 18th, Tim Walz said Tesla's at 225 and dropping. He says he just put it on his stock app in order to watch it and cheer on the destruction of an American company, which I just think is heinous, right?
Yeah.
And Jared Dillian, who wrote a couple of books we like, he's been on our show before, said buying Tesla right now based on that comment. And so far, he's done pretty well on it. That's why I wanted to put this up. But what do you see on here, Mike? Was that a double that fulfilled, or was it something different?
Yep, this double fulfilled, straight to the target and the 200. We talked about that. I talked about that in a daily. Funny thing is, we had now we don't normally go shorter term on this, but I'll show you what happened. This was triggered on Friday, and then here was your gap down on Monday. It was triggered on Friday, straight gap down, and if you look in look at this. I got slice.
You got slice?
I got slice. Look at this. Posted. Tesla completed double top pattern today, which was triggered on Friday.
Wait, is this on slice?
Yes.
What does that mean? It's on slice.
Share that screen. Share that screen so we can show people what that looks like.
Oh, I thought. Oh, sorry. Hold on.
No, you're not sharing it.
It's exciting stuff.
This is again where our newsletter is going to be housed for now. There'll be other places to get it, but this is where it's starting, and this is where you're going to be able to get the best price with that Finance 30 discount code. And while Mike's putting this up, Widge says yield should fall. It also likely means that inflation is less of a problem. And then Tim said, "Thanks, guys. Great answers. Credit spreads have gotten too little attention."
Amen. Both
not from our friend John, Tim. You know that. Okay. So this is what slice looks like. And Mike posted this. Did you not, Mike?
I did. It's posted. It was posted yesterday because it completed the pattern.
Now I want you to notice something here. It says private post. Can you zoom that in, Mikey?
Not easily.
Okay, never mind that. If you see,
can't easily zoom it in.
That's okay. I don't care. If you look at Finance Unfiltered, below that is the sort of handle, which is at Finance Unfiltered. Then it gives when it was done, and to the right of that it says private post. Okay, every fifth post is public. Okay, so that means anyone who's on Slice can see it. Only the people who are subscribers to us and our newsletter will be able to see all the posts. So somewhere in here, Mike has put a couple of things that could possibly happen. I put up a Wall Street Journal article screenshot. This is what Slice looks like. It looks very much like Twitter, except it is 100% markets. I just retweeted Bill Ackman's post on X, where he says Israel sets the example of how all our allies should preemptively respond to President Donald Trump's desire to level the playing field for Americas. I won't post that here. Okay, because it's just me retweeting something that I thought was right. Yeah. Here you see, as Mike's scrolling, you'll see some are private, some are public. Every fifth one is going to be public, and then they go back into private unless you subscribe. So here are some of the charts put in. You just passed the Wall Street Journal headline that I put on there. What was that? Oh, how the reversal of the American exceptionalism trade is implying that I put a commentary on that. That one ends up being public, because it was just the fifth one. So we don't even really have control unless we're counting, and we probably will be counting. I'll be counting, right?
I will not be counting.
Yeah. So if there's something I want to be public, I'll probably copy it and post it a bunch of times until it's public, just so other people can see it. But that's what it's going to look like. Anyway.
Are we done with all our assets or no?
No, Mike didn't finish commenting on Tesla.
Oh, of course not. Let's go. Yeah.
Saying how he got sliced.
Yeah.
You want further comments on Tesla?
Yeah.
There is not a fantastic pattern right now. Cycles are turning up on the daily and the weekly. Would not be surprised to see a bounce in the rotation zone. We do have delivery figures coming up, which I don't think are going to be good. So overall, I am still watching for further downside pattern. That's not rooting for it. It's watching for it. Okay. Fundamentally, it's still incredibly overvalued. Now we have gotten but the patterns have to play out. Like there's a double bottom that played out, a double top that played out. So it's a tradable instrument. Longer term, is there a great long-term bottom yet? No, there is not. Everything would just be for a bounce play only. And I don't have a fantastic setup at the time of this live stream. There just isn't one today.
That's all I wanted to talk about, unless you got something else that you saw that was important.
Funny.
You want to do crude?
I got to show this. This is so. maybe this is dumb luck. So it probably is.
It's
dumb
not.
But look at this. I posted yesterday, a day ago. Crude oil futures reach final double bottom target. If rally continues, next target 72.10 for the May contract. What was the high?
72.10. This is what I mean.
It's not voodoo.
I hate being. I was just going to say 72, but the target was still technically 72.10. I figured I'll just put that in there. And I hate getting stuff to the tick or to the penny. Why? Because if you had your target price, there's no guarantee you could get filled. That's why I hate getting stuff to the tick or the penny. But it did happen to hit it. That was a funny thing.
That is funny. All right, so let's wrap it up. There's one thing. Is that okay, Bob?
Yeah, we're good. Let me just read Sterling's last comment here. As an example, our government allowed the European countries and the Japanese to impose higher tariffs on us post-World War II so that they could rebuild. Did the same thing with Korea and Vietnam. We talked about at the beginning of the show.
Yeah, and Europe after World War II. There is a lot of tariffs in place. What Trump is doing is not crazy. If you think it is, you're not paying close enough attention. Do you want to have time to look at CCJ real quick? Yeah, okay.
Yeah, Timmy's a friend. So
right.
CCJ, Mike.
What do you want?
Uranium getting plastered, and I'm feeling it.
CCJ?
Yep.
Interesting. And this is not one I normally follow, but there is a completely valid. Look at this. Look at that little last major double bottom pattern. Look at that from back in August of 24. Look how that played out nicely. Then we now have another potential double bottom pattern. That's the only thing. We have not hit the magnet price though. Hold on, let me redraw it. We have not. We still technically have a slightly lower magnet price, and this would be only on a weekly. It would need to be a weekly close. Daily is too sloppy, and it is against the weekly rotation zone. Long way off from still triggering. Now, that being said, we could still head down. 38.82 is a very key harmonic level since we did close below 62.5 back in the week of back on the 18th of February. Did I say weekly? Yeah, that is back of the week of the middle of February. And the magnet price is still around 38.80. If we traded down there, it would not invalidate this potential double bottom and would give more time for the weekly rotation zone. So this is one, unless we have a sharp rally, I could still be watching for some downward pressure on price action and would be looking still for this double bottom to fully form closer to 38.82. Now, if we substantially start breaking down from there, the next magnet area would be the lows from the prior double bottom and reconnecting with the weekly 200, which has not reconnected since November of 20. And that would be a massive reset pattern against very key support. So would I be rushing into this right now? The only way I would be getting into this is if we triggered the bottom pattern. Otherwise, I'd be patient and wait for a little more retreat in price action.
So for those of you that don't know, this is Cameco, or is it Cameco? Tim, is it Cameco or Cameco? Number one or number two? Anyway, they own and operate some of the largest uranium mines. They have some of the largest reserves under their ownership, fuel services for nuclear reactors, and they have an ownership position in Westinghouse, actually. So that's what this particular company does.
By the way, just to jump real quick to I like to follow URA.
Yeah.
Also, URA, just to point out, this is why you got to learn double patterns. Triggered a double top back in mid-December. The little rally back did not invalidate it, came back down, reconnected. Now is broken a little below its 200, but against very, very key support. And we do have a potential double bottom, not triggered yet, double bottom on a weekly basis for uranium. So that's another thing. Uranium is one I like to trade around the core position because it rallies and it pulls back and rallies and pulls back. But the next major trigger would be as if this double bottom pattern triggers without getting invalidated on uranium at 25.78. And these are the kind of things we can put up on Slice too, because we can, if this does trigger, we can alert people.
Yeah, we'll do that for people with the newsletters. We'll allow you guys to reach out and ask Mike to analyze something technically, ask me and Jimmy to look at it fundamentally, whatever you guys think. So, but that's going to be for members only too. So.
Yeah, and that's again the first 30 members or so. We are going to be very appreciative, as we always are, to all you guys who have supported us the whole time. But we will give a lot of personal touches to it.
Yeah.
So, all right, I want to thank also our sponsor, Independence Arc Farms in Arkansas. These guys are farm to table. Farm to table, grass fed, grass finished. We complain about these food conglomerates controlling our food source. There is something we can do about it. And that's to patronize these small farms who do it right. Independence Arc in Arkansas. Special thanks to all of you guys who have watched us the whole time. Remember what Bobby and I's mission here. We were in legacy media for a long time. It is not the right way to do finance. There are too many sponsors and overzealous producers telling people what they can and can't say. We want to create a forum. We can say whatever we want, and we want you guys to be part of it and a beneficiary of it. Thank you guys so much. This is the Future's Edge. And remember, we are launching the newsletter. And it is going to be, I think I'm really excited about it. I hope you guys are too. It's going to be on the Slice app. Bobby, should we also post the Slice app too so they can find it? Or will they be able to find it?
Post it where?
I don't know, on our Twitter or whatever. I don't
know.
It's
in the bio of my Twitter now. And the link to get to us is going to be in the description for this video on YouTube. And I'm not sure if it's going to be everywhere, but it's definitely going to be on YouTube.
And I will definitely post it as well, too. Thank you guys very much. This is the Future's Edge. That is Mike Arnold, Chief Trading Strategist for Path Partners. I'm tired. I'm going home and eating dinner.
Remember, if you do sign up for the newsletter, Finance 30, that's going to give you 30% off for whatever length of package you buy in the newsletter.
And yes, Tim, we will for sure.
Yeah. So I better rush and sign up now so I have access to you guys, right?
Yeah, exactly. No, you'd never have access to me. I'm going. I blocked your